Hi, everyone. We're just going to wait a few minutes to see how many people join, and then we'll get started. Okay, we could get started. I'm Jackie McMahon. I'm the coordinator of the counseling program for Long Beach schools. Um, I know Miss Golden, our elementary school counselor, is on the presentation as well. And I'd like to just, on behalf of her and I, welcome you to our first ever partnership with the Long Island Financial Planning Group. We have Augie and Dominic here tonight to provide us information on 529 plans and how you can maximize your child's educational savings plan. I'm really excited selfishly. I have three elementary aged children at home, and this is a looming concern that just lives with my husband and I. So I am looking forward to learning about 529 plans, what they can be used for, and tips and tricks to help us along the way to continue to save for college, for other educational expenses, or apprenticeship programs, depending on what my children are interested in upon high school graduation or even during their K-12 experience. So I'm going to hand it over to Dom so we can get started. But thank you all for being here. I know it takes some time out of your family life to do this, but we really appreciate your participation.
Thanks very much, Jackie. So my name is Dominick Scarfogliero. I'm a wealth manager with the Long Island Financial Planning Group. So before I hand it off to Augie to get into the presentation, I just wanted to go through a couple of housekeeping. So we should be no more than an hour today. We'll definitely leave time for questions at the end. So the whole point of the presentation today is to be very educational, very basic, and go through not your unique situation, but just very generic information. So if you do have any specific questions, please feel free to put them in the Q&A on the bottom, and if we have time at the end, we'll get to them. I wanted to just showcase our website for a second. We are the Long Island Financial Planning Group. You can go to lifpg.com. So throughout the presentation, if there are any follow-up or any questions, you can feel free to head to the website, go to the Contact Us tab, hover over Contact Information. Our three faces are right there with QR codes with their contact information. And then you can always scroll down to request for information. And we'd be more than happy to get you that specific information that's unique to you and your personal situation. So with that said, I'm going to hand it off to Augie to get through the presentation. Again, please put any questions in the Q&A tab, and I'll come back to wrap up at the end.
All right, awesome. Thank you, Dominic. As everybody's mentioned so far, I'm Augie Abatello. I'm also a wealth manager over here at the Long Island Financial Planning Group. And tonight, obviously, the main goal is to talk about the 529, but I'm going to touch on some other tools and unique strategies that you might have heard of already that the 529 might be a little bit more appropriate for, or just in use in conjunction, right? And the overall theme of tonight is the financial plan, right? To have a strategy that has given some thought, not just randomly start investing some money in a 529 because you heard it on a webinar, right? So the goal is to get some good information to make diligent decisions for your family, and then based on your own values and beliefs, you'll really come up with a solid plan that you could use going forward. So I'm sure, as most of us know, college costs have been on the rise. It's not cheap, especially if you are, looking for that 4-year private school. So the goal is not to get overwhelmed tonight, right? Or kind of already, bury yourself under a rock and hide from the issue, right? It's to kind of really see what is important to you and your family. And if it is the goal, whether the values or beliefs you have, or the experience that you've had going to, a 4-year private school, you want that availability for your children, to kind of take a look at it, do some due diligence, come up with some numbers, and, put an action plan in place. Unfortunately, the other thing on the rise has been student loans, right? And unfortunately, sometimes disposable income or just the planning aspect falls by the wayside, and student loans have become a more popular way to get you through the college education experience. So, not saying that student loans shouldn't be part of the equation. For some of us, it might make sense in conjunction with the 529 or other strategies. But if we could, hopefully limit that as much as possible, that might be one of your goals, right? So that's where we set out and, really devise that action plan. So the age-old question is, how much do I have to save, right? And that really all depends on, what your wishes, the conversations you have with your children, right? Of what's important and all those your values. That, again, if it's your alma mater, or just the importance of going to a specific trade school to enhance their skills for a specific job or something that they have in mind. So with any goal, right? The sooner you start saving towards that goal, the easier it is to get to that mountaintop. So, for instance, in this example here, I'm showing on the screen, we have a savings goal of $200,000. So, if you had started right when your child was born, assuming an 8% return, that would mean a investment plan of $412 a month, or a lump sum of $50,000. All right. If we fast forward to, let's say your child's 12 years old, you would need to save $2,100 a month, or have a lump sum of 126,000. Again, earning that 8% to get you to 200,000 by the time your child reaches college age. So obviously, as you can see, right, it's a little bit more feasible the sooner you start towards it. But the good news is that no matter where you are in the stage of the game, we can always devise an action plan or come up with solutions to make college more feasible, more less debt burdening, and ultimately give you good financial success long term, not only for you but for your children as well. And one of the biggest things that is uncommonly said, but when it does come to college or buying a car or purchasing a home, right? We can get loans for those things. A lot of times when it comes to our retirement, there are no loans for retirement. So when we help our clients with financial plans, sometimes it might be, we have to go a little bit more of the loan route, for college, to make sure that we can still retire and enjoy our lives and we're not working, forever. So, the loans, obviously, we want to limit. It's not a dirty word, right? It's just part of the overall plan if it needs to be. But these are going to be some of the major ways that I'm going to talk about tonight of ways to save for college, right? With the main focus being on the 529. But I'm also going to talk about how custodial accounts, transferring funds from either grandparents or parents to the kids at the time of college, the Coverdell ESA. If you're not familiar with that, we'll introduce that type of an account. And then how cash value life insurance could also complement the 529 as well. So, the main star of the night, the 529 plan. This is become one of the more popular ways to obviously save for education in general, not necessarily post high school anymore. So it is available for primary and secondary tuition, fees and supplies and things of that nature. So it does take after tax contributions, which means that your contributions are not federally deductible. But if you obviously if you're living in New York and you use a New York 529 plan, you do get up to a $5,000 state deduction if you're a single filer. If you are a joint filer, it's up to $10,000. So you do get a little bit of a state tax deduction incentive for putting the money away. Contributions are considered gifts. So technically, there is no annual contribution limit, but you are under the gift exclusion, numbers. What that means is, as of 2025, you can gift a child up to $19,000 without any gift tax owed. So for a married couple, you can contribute $38,000, per year without any gift tax. Same thing for grandparents or anybody else. So the nice thing about the 529 is anybody can contribute to the account once it's opened. So if you are the parents and you own the account, anybody could contribute to that account. Now, if it's important for the person who wants to contribute to get that state deduction, a little bit more of a pain in the butt, but you could just open up a second account. So if the grandparents would really like that $10,000 deduction, they could open up an account. There's no limit to the amount of accounts that that one beneficiary has. A unique idea, whether it's yourself or your parents, so you're the grandparent of the child. If you have a large enough estate that you are looking to, lower, you can use what's called a 5-year dump-in. What that means is you could take 5 years of contribution, the 5 years of gift tax contribution limit of 19,000, which would be a total of 95,000 for a single filer or 190,000 for a married couple, and you could dump it in all at once. So if your child is on the younger side, let's say you have a 3-year-old at home, you have grandparents that are looking to reduce their estate for tax planning purposes or estate planning purposes. They dump in $190,000 into the 529. Assuming a hypothetical 7% return, that money sits there for 15 years. You now have over $500,000 available for your child for college, educational costs coming from the 529. So a nice unique idea that if you do have some family or parents or even yourselves where you have a decently large estate that you're looking to lower, nice way to kind of boost the savings there. The other thing is the money grows tax-free, right? So we don't have to worry about adding any of the returns that you get from the investments onto a tax return. And then obviously when it comes time, you have tax-free withdrawals for qualified expenses. So again, we don't have to wait until college or traditional university. You can pay for private high school or any other private schooling along the way for tuition fees, supplies, books, that type of nature. For any schooling that does require room and board, it's reasonable, meaning that if you go to a traditional college or university, the room and board is on campus. It's included in the total price tag. That is generally 100% considered a qualified expense. Actually, I have a client of mine who I was just speaking to last week. His daughter goes to school down south. She lives off campus in an apartment where he mentions the rent far exceeds what the room and board would be at the school. So, again, that would be an instance where, we're not CPAs, but, we give you enough information to speak to your accountant to get the A-OK. But he would be able to use the 529 up to the allowable limit for the room and board. And then anything above and beyond that, he would have to pay for that rent either from a different account, or if he wanted to use the 529, it would just be taxed and penalized, for a non-qualified expense. So don't be afraid of the non-qualified expenses, right? If you funded a 529, really well, there's enough funding to get through school for tuition, the room and board, all those major expenses. And let's say, unfortunately, your child needs a car or something along those lines. That would not be considered a qualified expense, but all the earnings and everything you've had, you're right, with the proper withholding, you can take the distribution, pay for those types of expenses, you pay ordinary income tax and a 10% penalty, but it's still accessible. It's not locked away forever. So you do have access to that money, even if it isn't a qualified expense. The nice thing about the 529 is that if you are the owner, you have complete control of the account. What that means is it doesn't matter how old your child gets, it never has to turn over to them. So in New York, the age of majority is 21. So the child does not take over the asset at 21. You stay in control of that account. Most accounts allow you to then add a successor owner. So God forbid something happens to you, another person of your choice could then take over the account for your child, whether they are below or above the age of majority. And as I mentioned before, you could withdraw the funds at any time, right? So whether that's prior to, while they're still in high school or middle school or anything along those lines for private or religious schools, anything along those lines, you don't have to wait. Technically, you put the money in, 1 month, you can take it right back out. So there's no holding period or anything along those lines once the money's in the account. And then as of the last few years, there's a new caveat to the 529 that if you do have extra funds after the child is done with their schooling, you are allowed to roll over 35,000, a maximum of $35,000 to a Roth IRA in the child's name. It is limited to the Roth IRA contribution limits per year. So for 2025, that's $7,000 a year. So if you have approximately $35,000 left over in the 529, over the course of 5 years, you would be able to completely roll all that money over to a Roth. And now the child has a nice little head start on retirement, or an accessible account that they could touch for obviously other things as they get their adult life started. The 529 for the most part is low maintenance, meaning that if you have an advisor like Dominic or myself looking over the account, we are able to manage it like most other investments, where there's a nice diversification, plenty of investment options that we'd be able to go over. Some of the plans have some nice age-based portfolios where the account is more aggressive when your child is younger, and it automatically shifts and get more conservative as the child gets older. So as they enter high school, there's a lot more bonds and money market instruments in the account. So if the market does, tumble, pretty severely, you don't have to worry about your college nest egg dwindling down because of a severe market downturn. So it really protects you in that way automatically. So that's for the basics of the 529. Obviously, each and every person on this call tonight is different, right? Has different views of risk, has different attitudes, beliefs, values when it comes to college education, the amount that you could save. So we really tailor each and every plan and 529 usage, to based on really what is preference for you and your family. So if you are a little bit more conservative with your investments, right, obviously we would have to maybe save a little bit more money, knowing that we're not going to get as high of a rate of return if we're a little bit more riskier with the investments as the child gets is younger, and then more conservative as they get older. But that's something we could talk about on a one-to-one basis, where it's more niche to you and your situation. An account that you probably have seen, or even might have used already for your children, is called a custodial account. Right, it's sometimes as simple as in when they're born, whether it's religious events or birthdays. Right, we set up a bank account and in their name, and you see that title of the UGMA, UTMA on it. So custodial accounts are irrevocable gifts to the child. So they have to be used for the purpose of in the benefit of that child. So the big thing to keep in mind is that it is 100% that child's asset. So when we're talking in terms, if you are potentially looking for financial aid and filling out that FAFSA form down the road, the 529 is vastly different than the custodial account. 529 would be considered, again, if you're the parents and you're the owner of the 529, it'd be considered your asset, whereas the custodial account is 100% the child's asset. So in the financial aid calculation, child assets count way more against for financial aid than the parent's asset do. So there is a 1-year look back. So if you do have a custodial account, and let's say your child is a senior in high school, you decide to buy them a car, and then 3 months later you go to file for financial aid, there is a 1-year look back. They will see that was that child's asset. It will hurt you for that year that you're looking to get the financial aid. So if you are potentially in the ballpark of getting financial aid and your child has custodial accounts, it might make sense to draw those down prior to that time frame. Again, for the benefit of your child, maybe buy those computers, car, whatever, before they get to a certain point, so the look back is over and it doesn't hurt against the financial aid. And then same thing for 529s. If you have a grandparent that owns it, that's completely then out of the parent and the child's name completely. So that's eliminated from the FAFSA equation, the financial aid equation completely. The one other major drawdown to the custodial accounts is when the time comes to the age of majority. So in New York, it's 21. The custodial account becomes 100% the child's, in the child's power. So they take over the account at 21. So some parents are uncomfortable giving a sizable lump sum that becomes their child's, as they are entering junior, senior year of college. They at that point become the most popular kid on campus in some cases. So, again, just want to be aware that, if they do carry that custodial account, through and through, it does become 100% them as the owner at 21. The Coverdell ESA, this has become less and less popular over the years. One being that the annual contribution limit is $2,000 per beneficiary. So doesn't matter how many people contribute, it's per child, only 2,000. They never inflated it, for inflation or anything like that. Increased it for inflation. It does have tax-free withdrawals. You can use it for private education along the way, so you don't necessarily need it for college. But ever since they changed the rules for the 529 and allowing that available, the ESA has gotten less and less popular because the 529 carries a lot of the same benefits, and you could have it all in one pot. The one thing I forgot to mention earlier with the 529s when it comes to pre-college, so like private high school tuition, things of that nature, it is up to $10,000 a year, so it's not unlimited for those expenses. Once you get to the secondary schooling, so trade schools, universities, colleges, whatever it is that your child goes to after post high school, there's no limitations to obviously whatever the tuition is and things of that nature. There are some tax incentives along the way. One is called the American Tax Opportunity Credit. So this is for undergraduate students for the first 4 years. You do get a dollar for dollar tax credit up to $2,500 per child. The one downside is that the phase out period, the phase out income is 80,000 for a single filer and 160,000 for joint. So obviously, I know that's not a tremendously large phase out. Obviously, even just to have a home and lifestyle on Long Island. But if you are in the ballpark of being in that realm, you could have it for as many children as you have. So if you have 3 or 4 kids going to school around the same time, all 4 of them are able to get it. The other is the lifetime learning credit. So that one is available for both undergrad and graduate students. It is a $2,000 credit. You could have two children get the American tax credit and one child get the lifetime learning credit. Just one child can't get both of those credits in the same year. All right. So it is something that if you are on the cusp of around those income limits or under, definitely just something to bring up to your accountant as you are starting to prepare for those college years, because it is something that is available to you in addition to all the savings that you get with the 529s. Then we have cash value life insurance. This, as I mentioned earlier, could be a supplement to those 529s. This could actually be life insurance on your own life that you have already, that, with, looking at and doing some due diligence, you could, maintain or change how you're funding that life insurance to provide a little bit more money for, college educational costs. Or this could be life insurance on your child, right? So, depending on how old they are, it could be relatively pretty cheap, when they're young. So again, we're using after-tax contributions. The one nice thing is there's no income limits, right? So you don't have to worry about the amount of money you make to fund the life insurance or anything along those lines. Along with the 529, you can control the policy. So again, you could be the owner. It doesn't necessarily ever have to change ownership. You could own the policy forever on your child if you want. Obviously, if it's your own policy and you own it, already, you don't have to worry about that. When it comes to the financial aid, cash value life insurance is excluded from that ratio. So again, it shelters you from that ratio. Again, there's no time limit to it. So as long as your life insurance policy or the kid's life insurance policy is funded correctly, you can use those funds at any time. The values grow tax deferred. You can take income tax-free loans. And the most important part is, God forbid, the unfortunate happens sooner than later. It allows your college plan to self-complete itself. And what I mean by that is obviously the death benefit of that life insurance. So it does provide your family with the tax-free benefit to have those funds available if you don't get to complete, the savings plan that you had in place for your children for school. So they don't have to necessarily, give up all the plans that you guys, have put together. So if there is a school that is meaningful, to the family, they could still continue on that path, even in the case of an untimely death. Um, and then the last thing is low maintenance, right? I myself have a 3 and 5 year old here at the house. When they were first born, I got both of them whole life insurance policies, so they have a set cash value where there's a dividend that grows. My 5 year old, she already has over $300,000 of death benefit. I have a index universal life for myself. So again, pretty low maintenance. There's no major investment aspects to it. So when the time comes to the children going to school, I have the 529s, right? And then I have three other areas technically to loan some money from. And a lot of times you'll hear Dominic, myself, and even our third partner, Jeremy, talk about money is money, right? So meaning that if we are able to borrow from ourselves at a, let's say, 2 or 3% interest rate, I'd much rather pay myself back that 2 or 3% rather than having to go get a Stafford loan or some type of student loan that you're going to be paying maybe potentially double digits on, right? So that's really all the conversations we try to have when we set up a plan is what do we have available? How much can we fund that 529? And none of the other strategies that we have, what are some other ways that we can create some extra money so it's available to you at maybe a better interest rate that we can control. The one thing I'll just say for life insurance, depending on how active you are on social media, just be careful. I know, my wife is very involved in TikTok and Instagram and Facebook, and she always showed me these videos of these influencers, with the quote unquote building your own bank with life insurance. Just be very careful. Their assumptions are, really nuts sometimes and unrealistic growth or returns. So if you really do want to complement your 529 plans, if you have life insurance already or are looking to do that either for yourself or for your kids, Dominic, myself, Jeremy, we are licensed, for life insurance, and we could kind of run through that and give you a realistic idea of how much, money would be available depending on the funds available to fund that life insurance. So I know I've talked about a few different ways of how to save for college, right? The main being the 529, but each of the other aspects, whether it's the custodial accounts, the cash value life insurance, transferring funds from the grandparents or your estate or accounts, things of that nature, and then the covered ESA. It's just all the pieces, right, to creating a sound plan that hopefully will alleviate a lot of the anxiety that college costs bring to every household, right? So, if whatever the goals of that household is, from the plans of whether it's a state school, local, even that 4 year private school, that could be on the more expensive side. As long as there's a plan in place, it also then allows all the other parts of your financial life to work together, right? So meaning that the educational funding doesn't take away from your retirement funding or anything along those lines. You have a sound plan, and that's where Dominic, Jeremy, and myself really come in, is we really help you to learn, how much do I need to save? How much can I save? And we start from the very basics of a budget to see, hey, what's coming in, what's going out. We can do a cash flow analysis for you to really, dive deep into seeing, what kind of income you have coming in, from which sources, what kind of expenses do we have, what's fixed, what's variable. Are there some variable expenses that we could lower and make room, for some of them additional college savings? And that's really how we get started, right? Is going through the basics of sitting down, just getting to know what's important for you, your family, your kids, yourselves, all that, your beliefs and values, how much it's going to cost, for that ideal, potential college education, trade school, whatever it is that's important to you. Look at what, obviously inflation is going to do, right? So if you have, children who are young, there's plenty of room for a lot of inflation to continue to drive the costs even higher. So we'll take a look at what that overall cost might be 10, 15 years from now. How much money do we need? How do we save it? What areas do we do? All 529 or bits and pieces in a bunch of different areas. And then we could have that conversation. If we overfund, how do we take the money out and do all those things that I mentioned before? So like Dominic mentioned, and I'm gonna turn it back over to him in a second. By just setting up some time with us, we can meet obviously at our office, your home, phone call, Zoom, whatever's most convenient or just time efficient, for obviously, like I said, having two young ones for myself, knowing time is usually an issue, but we don't want to put it on the back burner too long because, as we all know, those 3 and 5 year olds turn to be, 15 and 18 pretty quick. And it's important that we have that plan in place because, as we've seen, right, the sooner you attack a goal, it makes it more likely that you'll achieve it. And the three of us pride ourselves on not only just setting up a plan for you, but making sure that we follow up, and each and every year we change and adapt those goals to make sure that it's tailored for whatever you need. So thank you for your time tonight. Really appreciate being able to speak to everyone. Look forward to hopefully speaking again at some point in time and helping you along the journey to for your educational cost goals.
Thanks, Augie. So there was a lot of really good information tonight. Somebody asked a question in the chat. I went ahead and answered it. But I wanted to point out there's a lot of information, like Augie said, online, social media, a lot of different places. Our website is a really good resource for a lot of those questions. So if you just go on to, again, lifpg.com, hover over the resources tab. We have a lot of these educational videos that we do saved on YouTube on our website. If you go to the investment center, you can see all articles just like this. So somebody had asked about a 529 to the Roth IRA, right? Obviously, please feel free to reach out to us, but the answer is right here on the website. In a quick article, it's all sourced directly from the IRS. So if you have a lot of these questions, make sure you're getting it from a reputable source. While the point of the conversation today was about college savings and 529s, there are a lot of other avenues where we work in. We do specialize in retirement planning. We do a lot of work with investment, whether it's a Roth IRA, traditional, tax managed investing. We focus on our financial planning work, right? So whether that's college planning, retirement planning, tax planning, 401k planning, 529s, right? We'd be more than happy to help. So how do you do that again? Hover over the contact us on the top. You can click one of the links directly on there, fill out the information with any questions. Like Augie mentioned, we know you guys are busy, so we put our calendar directly on the website. Feel free to click a day that works best for you. If you want to do Zoom, it's going to send you a Zoom link automatically, just like the webinar today. If you want us to come to the house, we'd be more than happy to do that as well. But thank you very much for the opportunity, Jackie. I'm not sure if you want to say anything else, but thanks again for the opportunity. I hope you learned a lot, and we look forward to speaking to everybody shortly.
Thank you to our families. If you can't find your answer, I know that you can contact them directly, but you can also reach out to me or Miss Golden, or if your student is in high school or middle school, their school counselor, and they'll be able to get you in touch with the right people. And I hope you all have a great night.